5 warning signs your bookkeeper is stealing from you. Is your bookkeeper stealing from you right now? These 5 warning signs could reveal fraud that's been happening under your nose for months. Warning sign number 3 is happening in nearly half of all small businesses. I'm Bev, and in my 30 years of finance, I've investigated more bookkeeper fraud cases than I care to count. Each time, the owner said, I trusted them completely. I never saw it coming. Today, I'm sharing warning signs that could save your business. If you use an outside bookkeeper, this video is crucial. Warning sign 1, your bookkeeper insists on controlling every aspect of your finances. Let me tell you about a case that still haunts me. I was called in to investigate after a small manufacturing company discovered their bookkeeper had stolen over $200,000. When I interviewed the owner, he told me something that made my stomach drop. She handled everything. She opened our mail, deposited our checks, paid all our bills, reconciled our bank statements, and prepared our financial reports. She said it was more efficient that way, and honestly, I was grateful not having to deal with the financial stuff. This bookkeeper had essentially become the financial dictator of the business. Here's exactly what she was doing. When customers sent checks, she would deposit most of them normally into the business account. But occasionally, maybe once or twice a week, she would take a customer check and deposit it into her own personal account instead. Then she'd mark that customer's account in the system as having made a payment that was returned for insufficient funds. She'd send a very professional-looking NSF notice to the customer, complete with bank fees, explaining that their check had bounced and requesting a replacement payment. The customers, usually embarrassed and confused because they knew their accounts had sufficient funds, would quickly send another check. This second check would be deposited normally into the business account. She got away with this sophisticated scheme for 3 years because no one else ever touched any part of the financial process. There was no separation of duties, no verification, no independent review. But here's what made this case even worse. When customers occasionally called to question the NSF notices, she would handle those calls too. She'd been given authority to deal with customer service issues, so she'd make up stories about bank processing errors or computer glitches, and customers usually accepted her explanations. The red flags that should have caught this is your bookkeeper insists on opening all mail personally and gets defensive if you suggest someone else could help. Professional bookkeepers understand that mail distribution is not typically part of their role. They resist when you try to maintain any control over banking functions. If they push back against you having online banking access or reviewing bank statements, that's a major red flag. They've positioned themselves as the single point of contact for all financial vendor and customer communications. While they can certainly handle routine inquiries, they should never be the exclusive financial contact. Your bookkeeper should handle data entry, reconciliation, and report preparation. But you should maintain control over banking access, vendor approval, and financial policy decisions. If they resist these boundaries, that's concerning. Warning sign 2, your financial reports are always late, and there's always a reasonable sounding excuse. Professional bookkeepers understand that timely reporting is crucial for business decision-making. If your monthly reports are consistently weeks late, that's not just inconvenient. It could indicate manipulation time. I worked on a particularly troubling case where the bookkeeper was always 3 to 4 weeks late with their monthly reports. She'd give explanations like, I'm waiting for one last invoice to clear up a discrepancy, or I want to make sure everything's absolutely perfect for you, or the bank had some processing delays this month. The business owner actually thought she was being extra thorough and appreciated her attention to detail. What she was actually doing was using that extra time to manipulate the numbers to hide her theft. Here's her specific process. She was stealing money throughout the month through various different methods: fake vendor payments, duplicate expense reimbursements, occasional cash deposits into her personal account. By the end of each month, her theft had created discrepancies between the bank balance and what the books should show. She used those extra weeks to move money between different accounts, create fake journal entries to balance things out, and even forge supporting documents when necessary. The delay gave her time to make sure everything looked normal and balanced. But there were additional red flags in her reporting behavior. The reports, when they finally came, often had round numbers in unusual places. Adjusting journal entries were frequently for amounts like $500 or $1,000, which is unusual for legitimate corrections. She would include vague exclamations for discrepancies like bank reconciliation adjustments or processing corrections without specific details about what caused these adjustments. She discouraged questions about the reports, saying things like, "The numbers are correct, but the details are complicated," or "Trust me, everything balances out properly." Here's what professional bookkeepers do differently. They provide preliminary reports on time and make any necessary adjustments in the following month's reports. They don't hold up entire monthly reports for minor issues. Your monthly financial reports should be available within 2 weeks of month end for most small businesses. If your bookkeeper consistently can't meet this timeline, they're either overwhelmed with too many clients, disorganized in their process, or potentially hiding something. And here's a crucial test. Call your bookkeeper on a random day and ask for quick answers to basic questions like, what's our current cash balance? Or how much did we spend on office supplies last month? A competent, honest bookkeeper should be able to answer these immediately or within minutes. Warning sign 3, and this is the big one affecting nearly half of all small businesses. The bank reconciliation your bookkeeper provides doesn't match your actual bank balance, and they always have explanations for the differences. Let me first explain what a bank reconciliation is for those who may not be familiar. It's the process of matching your accounting records to your bank statements to ensure everything agrees. Your bookkeeper's records should match your bank balance exactly, with clear explanations for any timing differences like checks that haven't cleared yet or deposits that are still processing. I want to share a case that perfectly illustrates how this warning sign plays out. A restaurant owner hired me when he noticed something odd. His bookkeeper's monthly reconciliation consistently showed about $15,000 more in the bank than his actual balance. When he asked about it, she had ready explanations. "It's credit card processing delays," she'd say. "The credit card companies are slow processing this month." Or, "There are some checks outstanding from last month that should clear soon." She always sounded knowledgeable and confident, and these explanations seemed plausible. But here's the critical red flag. These same discrepancies kept appearing month after month. Real timing differences resolve quickly. A few days for credit card processing, maybe a week for checks to clear. When the same outstanding checks appear on reconciliations for 3 months, that's not a timing difference. That's manipulation. What this bookkeeper was actually doing was brilliant and terrifying. She'd been creating fake deposits in the accounting system to cover up money she'd stolen. Every month, she'd steal a little more and create another fake deposit entry into the book's balance. She'd tell the owner the money was coming soon, while she figured out how to manipulate the next month's numbers. The discrepancy kept growing because she kept stealing, and eventually, she couldn't keep up with the fake transactions needed to hide the growing gap. Here are the specific red flags to watch for in bank reconciliations. The same outstanding checks appearing month after month. Real outstanding checks clear within a few weeks maximum. If check number 1247 is listed as outstanding for 3 months, that check either needs to be voided and reissued, or it never existed in the first place. Vague explanations for discrepancies? Professional bookkeepers can explain exactly why there's a difference. Check 1255 to ABC Supply for 347.82 hasn't cleared yet. Or Friday's deposit of 1240.33 won't show on the statement until Monday. They don't give fuzzy explanations like processing delays or timing issues. Growing discrepancies over time. If the difference between your bookkeeper's reconciliation and your actual balance keeps getting larger, that's a serious red flag. Here's what you need to do. At least once a month, compare your bookkeeper's reconciliation to your actual bank balance. Log into your online banking and check the current balance, then compare it to what your bookkeeper says you should have. The only acceptable differences should be very recent transactions, checks you wrote in the last few days that haven't cleared, or deposits from yesterday that haven't processed yet. Everything else should match exactly. Warning sign 4, your bookkeeper actively discourages you from accessing your own bank accounts or reviewing statements, and they have convincing reasons why this is better for your business. This manipulation tactic is more sophisticated than you might expect. I've heard bookkeepers use arguments that sound almost professional. Multiple people accessing the account can cause confusion in the reconciliation process. Or it's better to have one person handling all banking to maintain consistency. Or you might accidentally authorize something that could mess up my bookkeeping. Let me share a case where these manipulation tactics were used masterfully. The bookkeeper told her client that banks sometimes flag accounts for unusual access patterns when multiple people log in frequently, and this could trigger security holds that would freeze business operations. She said it was industry best practice for only bookkeepers to access accounts. None of this was true, but it sounded professional and authoritative. What she was actually doing was transferring money from one business account to a personal account she'd set up with a name very similar to the business name. She then categorized these transfers in the books as payments to legitimate business categories, like equipment purchases or contractor payments. Because the owner never looked at the actual bank statements, he never saw these transfers were happening. He only saw the categorized expenses in her reports, which all looked normal and business related. Here are the specific manipulation tactics to recognize. They claim you'll confuse yourself if you look at the raw bank data. This is condescending and designed to make you feel like banking is too complicated for you to understand. It's not. They say multiple logins will cause system problems or security issues. This is false. Banks expect business owners to access their own accounts regularly. They insist that they need to be the single point of contact with the bank for consistency. While it's fine for them to handle routine banking communications, you should always have direct access to your accounts and the ability to speak with your bank directly. They become irritated or defensive when you ask about banking access, making comments like, "Don't you trust me?" or "This is how I work with all my clients." Here's the truth. You should have full, unlimited access to all of your bank accounts at all times. You should review statements regularly. You should be able to call your bank directly whenever you want. A professional bookkeeper will not only allow this, they encourage it because transparency protects both of you. If your bookkeeper gets defensive about your banking access or tries to convince you that your involvement is somehow problematic for their processes, that's a major red flag. They work for you, not the other way around. Warning sign 5 is your bookkeeper's lifestyle doesn't match their known income from your business and other stated sources, and there are no reasonable explanations for sudden financial improvements. I want to be very careful here because people have private financial lives, and there can be legitimate reasons for lifestyle improvements. Inheritance, spouse's income, wise investments, or income from other clients. But dramatic lifestyle changes during their time working with you deserve attention and additional oversight. Let me tell you about the most obvious case I ever encountered. A bookkeeper was making $40,000 per year working with a small medical practice. Within 6 months of starting with them, she bought a boat worth $35,000, purchased a new truck worth $45,000, and completely remodeled her kitchen, which cost an estimated $25,000. When the practice owner casually mentioned how well she must be doing financially, she explained she'd inherited money from a distant relative and had also started a successful side business selling crafts online. The practice owner didn't think much of it until other issues started surfacing: late reports, defensive behavior, reluctance to allow banking access. When we investigated, we discovered the inheritance story was completely fabricated, and there was no craft business. What we found was that she'd been systemically stealing through a sophisticated vendor fraud scheme. She'd created several fake companies with names that sounded like legitimate medical suppliers. She'd submit invoices for things like medical supplies, equipment maintenance, and office services, and then cash the checks made out to these fake companies. The total theft over 8 months was over $80,000, exactly enough to explain her sudden wealth. Here are the lifestyle changes that should get your attention: expensive vehicle purchases, especially if they mention getting a great deal or paying cash for cars worth more than their annual salary from you. Luxury vacations that they discuss frequently or post about extensively on social media, particularly if these seem inconsistent with their known income level. Major home improvements or new expensive hobbies, or sudden acquisition of high-end items like jewelry, electronics, or designer clothing. But here's the key: it's not just about the money they're spending. It's about their attitude toward money. Honest people who come into legitimate money are usually happy to explain their good fortune. People spending stolen money often become evasive, defensive, or create elaborate cover stories. Pay attention without being invasive. If you notice significant lifestyle improvements, it's completely appropriate to implement additional financial controls and conduct more frequent reviews of your books. Remember, honest bookkeepers actually want strong controls because it protects them from false accusations. Beyond these 5 major warning signs, here are some additional red flags that often appear in combination with the main ones. They insist on working from home exclusively and resist any suggestion of working in your office, even occasionally. While remote work is normal, complete avoidance of your business location can indicate they're hiding something. They're always available and responsive, except when you ask specific financial questions, which suddenly take days to get answers to. They discourage you from speaking directly to vendors or customers about financial matters, insisting all communication should go through them. They show unusual interest in your personal financial information or ask questions about your other bank accounts, investments, or financial plans that aren't related to their work. They resist using standard accounting software, preferring to maintain records in spreadsheets or their own systems that are harder for you to review independently. If you've recognized any of these warning signs, here's exactly what you need to do. Don't confront your bookkeeper immediately. You need solid evidence first, and early confrontation gives them time to cover tracks or destroy records. Conduct an independent bank reconciliation yourself for the past 3 months. Print your bank statements and compare them line by line to your bookkeeper's records. Change your banking passwords immediately, but don't tell your bookkeeper yet. You want to maintain their normal access while you investigate, but you also want to prevent any additional damage. Document everything you discover, but keep this information completely secure and away from the suspected bookkeeper. Consider hiring a forensic accountant for an independent review. especially if the amounts involved are significant or if you find clear evidence of discrepancies. Remember, catching fraud early minimizes both financial damage and emotional trauma. The longer fraud continues, the harder it becomes to recover from, both financially and psychologically. Have you ever experienced any of these warning signs in your business? Please share your story in the comments. Your experience could help other business owners recognize problems before they become disasters. Subscribe for more fraud protection strategies, and remember my golden rule: trust, but verify. Always. I'll see you next week, where I'm covering what to do in the first 48 hours after discovering fraud.